Yeah, hello everybody. I'm genuinely happy to be back on the channel after a break during the semester. Now I'm going to continue with my introduction to value-added tax. And we have spoken until now about exports, so it's relatively logical that now we begin to speak about imports. So imports from third countries, that's our topic just now. Just have a look to see where we are at the moment. So after talking about exports, we are now going to deal with imports from third countries. So the importation of goods in the inland and the treatment of the seller who sells goods which are imported. These are the main topics, and we also have some tax regimes for special situations to cover. So there will be not too much leisure time. So let's just begin. Well, the importation of goods in the inland or into the inland, however you define it, that can be found in German law in paragraph 1, subsection 1, number 4 of the German Umsatzsteuergesetz, the USTG. Tax exemptions will be defined in paragraph 5 USDG, which are relatively rare and not of much interest if you are not a haulier or someone working in a similar part of the economy. Tax base would be paragraph 11. The tax rates are the usual ones, and that's it. Well, in the EU directive, you find the underlying EU legislation in Article 7 for 71 for taxability. Tax exemptions will be found later in Articles 143 to 145. And when it comes to the tax base relating to importation cases, there you find them in 85 to 89. Okay, because in general you can already register or keep in mind that in the EU directive, the tax exemptions are listed at the end of the testing scheme. So here they describe the regular flow of events first and then list the exemptions differently from the German testing scheme. That explains why the exemptions come later in the articles than the tax base. Well, now the importation of goods. How is it defined? So what do we talk about? Importation of goods is nothing else than bringing goods into the customs territory of the EU. That means into the VAT inland. You remember that from the last but one video that the customs territory or the VAT territory of the EU does not include all the territory of the EU member states. For example, Heligoland and Busing and these strange municipalities of Germany are left out. And for example, the Canary Islands for VAT purposes do not count as part of Spain and all this stuff. So, but bringing goods into the VAT inland of the EU triggers the importation tax under VAT rules. Now, you need to define where you have to pay importation tax, and that is just defined by the place of importation, which is no no surprise. It can't be a surprise because we had we had deliveries and we had a place of delivery. We had services and we had a definition for the place of service. We had intra-community acquisitions or a place for that. And now we have an importation, and so there is a rule where the importation has to be taken into account. So the rule will be the place of importation, which means for you and me and everybody in an exam or in a practical case, never ever approach a case solution on an importation, one number 4, with a rule where you then talk about the place of delivery or the place of service, because for importation you need the place of importation clearly and simply. The place of importation is determined as the same place where your customs duties affairs have to become regulated, so where the customs duties are collected, are due, are processed. So basically, the place of importation is just determined according to the customs code of the European Union. So it comes from outside tax law, it comes from customs law. Well, now we are not probably familiar with customs legislation, so let me just tell you the basic rule for the place of importation is simply the place of importation is in that country where the good crosses the external border into the EU. So if somebody comes with a good in his or her baggage from Switzerland and walks over the border to Germany with that good in the rucksack, then this is simply an importation into Germany because the good you crossed the good, you crossed the border with the good on the German border. Now there might be special rules where you can deviate from that basic rule. For example, the importation procedures can be postponed, and the importation also is then postponed if and as long as the good in question is under the direct or indirect supervision of the customs authorities, and the customs authorities have agreed to postponing your importation until a later date and probably to a different location. In such a case, the importation only takes place at that place where, in agreement to what you fix with the customs authorities, the importation is performed and the importation duties are paid, so the customs duties. So that happens at the same time. So a simple example would be a lorry comes from Switzerland and crosses the German-Swiss border. So the guy in the vehicle crosses the German-Swiss border. So that guy, under the basic rule, would import these goods into Germany. And if you don't have a deviation from that basic rule, so if you don't have an agreement or make an agreement with customs authorities, that will be the rule which counts. However, imagine these goods now are meant to go to Spain and the lorry driver has now no interest in paying German importation VAT, later claim it back as input tax, then go to Spain, sell the goods there, probably fill out documents there again. And so it might be that the owner of the goods can apply or will apply or wants to apply to the customs authorities and says, I want to postpone the importation until the lorry arrives in Spain, and go there to the local customs office and do the importation stuff. In that case, the place of importation would then be, let's say, Madrid, the capital of Spain, and the importation only takes place there at that moment, not earlier. The only exception is if during such, let's say, such a special agreement with the customs authorities during the transport over EU territory in a non-imported status, these goods are removed from the supervision of the customs authorities. So if you, let's say, park the lorry in a dark forest and unload all the goods and they vanish, then the person who has entered into such an agreement with the customs authorities is responsible for all the customs duties and importation VAT, and then the importation takes place at the good where at the place where these goods vanished from the customs authorities' supervision. So in that case, in that dark forest, that would be the importation place of importation then. Well, that's rather strict, by the way. For example, if the lorry in question gets stolen with all the goods on board somewhere in France, that would be nice, because when they are stolen, the goods are no longer covered by supervision of the customs authorities. Nobody knows now who has possession of these goods. In that case, at the moment when the goods vanish from the customs authorities' supervision, so when they are stolen, that is deemed to be the place and time of importation, and so the owner will have to pay the importation duties in such a case. Um, Apart from the cases where the owner can prove that the goods have not been stolen but completely destroyed and so cannot enter the market. The idea behind that is when you cross a border, you usually have to pay the tax. If you make an agreement to postpone the importation, then you are fully responsible for the fate of the goods later, and that they will not, under no circumstance ever, enter the free market without having been taxed and subjected to the appropriate customs duties. Now, if something happens, you guarantee that they will not go into free circulation. And, well, if something happens which you didn't foresee, nobody asks if you wanted it or not. If it's just bad luck, well, it's your bad luck. Then you have to pay the importation VAT and the customs duties. So you have no incentive to get your goods stolen behind the border because if the importation has not yet been made, you are liable for the taxes under all circumstances. So when you want to insure the goods during the transport, you will have to keep that in mind when you calculate the value of these goods. Okay, another example. A good shall be sent from a third country to a customer in the EU, and the customer is meant to pay the importation VAT. That can happen, and in such a case, as long as the customer has not shown up in the customs office and paid the importation duties and the customs duties, including importation VAT and all that, then the goods are not yet imported. So, for example, if that customer resells these goods during that period of time to another customer, then a good is sold which has not yet been imported. That has certain special consequences which we probably hear later. Yeah, tax exemptions for importation VAT are relatively rarely relevant. So first let's again sum up. The importation taxability is simple. Importation is a good crosses the external border. That triggers importation. It might be postponed. Second thing is the place of importation is there where the customs duties, the customs code of the EU says it. And so if there is no special arrangement where the good crosses the border, or if there is a special agreement, then when the importation duties become payable. Okay, so tax exemptions are relatively strange, rare, and so we don't have to bother about them. If somebody wants to look them up, they will be found in paragraph 5 of the USTG. They are, as I said, rare and rather technical. And especially when you think, okay, there might be cases where a good is just crossing over the territory of the EU but does not remain in the EU. For example, the good comes from Turkey and is transported to Norway, which is, as you know, not EU, then it just crosses our territory and then leaves again. In such a case, a tax exemption would not be found in paragraph 5, because then usually you would agree with customs authorities that the mere transfer of the good through the territory of the EU does not constitute an importation. You would just drive through under the supervision of the customs authorities, and so there would be no importation at all. Yeah, the tax base for an importation is the customs value. That should normally be the market value. There might be cases where the customs authorities have to estimate that. So in most cases it is the market value, but it might deviate from that. And there are special situations where, for example, the transportation costs to the place of destination in the EU are added to the price. The idea is that the value-added tax should be paid on the total amount of costs, so the price and transportation, which your customer would have to pay if the customer had bought that good at the customer's location from a trader or so. So also the transportation cost should not remain free of value-added tax, and that is ensured by a rule that like this. So if, for example, the transportation costs are not yet included in the sales price, the customs authorities would add them up to that. Rather technical, so hear it and forget it. The tax rates, however, are the regular tax rates of the member state where the importation tax takes place. So when you import something in Germany, then the importation VAT will be regularly 19% at the moment. This is 2022. And the reduced rate will be 7%, for example, for chocolate, for milk, for coffee in form of coffee powder, and things like that, or for books, 7%. So, yeah, it depends how high something is taxed on where it is imported. So, a computer imported in Germany would be 19%. The same computer imported in Denmark only, then the importation VAT would be taxed at the rate of Denmark, 25%. It would really make a difference. For example, if you import chocolate to Germany, it's 7%. In Denmark, the same thing would be 25%. However, if you do it as a business person, then the importation VAT will, in most cases, only be temporary and will later be replaced by the regular VAT on your sales prices, so that this, let's say, this small difference where you import and where you pay the importation VAT does not really influence the final conditions under which you sell to the market. Okay, that is good enough and enough for the first chapter. Um, Enjoy this, and I hope you see me again soon on this channel. Goodbye for today.